Call that we're going to be addressing today is really on the markets, the election. We're going to talk about what was, is, and could be going forward, and also we'll have some information on the election. So kind of jumping forward, if we look at what was, we just left and probably still in one of the largest economic expansions ever in history. We entered 2020 with a gross domestic product of about 2.4%. And that was calculated all the way up to about February, shortly after mid-February, late February, 1st of March, we entered the pandemic, the forced shutdown in the economy. We had an unemployment rate of about 3.5%. Now, keep in mind, that unemployment rate is really the best we've ever seen. And in mid-February, we saw the S&P, the Standard & Poor's Index 500, hitting all-time highs. And the NASDAQ and the Dow Jones Industrials weren't far behind. If we look at what is, the economy is shut down. We shut down for a pandemic. We're still in the middle of it. We're trying to reopen. Hopefully, we won't drift back down into a shutdown. But there is some question marks, at least overseas, that came out today from the United Kingdom, that they might be setting themselves up for another shutdown. Of course, I hope we don't see that over here. I don't think that's going to be the situation. But we did have massive economic and fiscal stimulus. That's where you've seen the economic policies, the government, the Federal Reserve pump mass amounts of cash, trillions of dollars, and probably trillions of dollars more into the economy to prop up and sustain or promote growth back into the economy. If we look at the gross domestic product compared to February or the start of 2020, we're down 31.7%. And if you recall on the previous slide, we started out the first of the year at about 2.4%. Question marks about the first of the year. There were question marks. Are we going to be drifting into a recession? Of course, no one planned for a pandemic in this type of shutdown. The unemployment rate right now is 8.4%. Well, during the height of the pandemic, we were down roughly about 14 to 15%. So we've improved dramatically to only be 8.4%. Interest rates are at record lows. Why? Anytime that you've seen stress in the economy, let's say from 2008 all the way to this time, you'll see interest rates really drop. Why? They want to make borrowing costs very low to help spur and sustain growth or to promote growth to get us back to higher economic levels. Now we're in the middle of the markets, the stock market, if you might, and bond market of haves and have-nots. We really is a tale of two tapes. We have a section of the market that's really outperformed, hitting new highs and questionably high valuations that might be a little hard to digest. And that would be like with the technology stocks. But we've had materials, housing, home investments, something that I like to call anything that's COVID positive, anything that's going to help us stay at home, stay out from hanging out with the masses and be more productive. And that's not just personally, but that's for corporations. What have been the losers? Unfortunately, it's been the banks and energy, restaurants, and there's definitely other ancillary industries that have been affected. And there's going to continue to be effects of this shutdown going forward. Now, unfortunately, the banks and the energy were probably laggards coming into this. They still are laggards now. If we look at the S&P, the NASDAQ, and the Dow, listen, they're hitting all-time highs all the way up to about 3 weeks ago. And then as of about 3 weeks ago, 2.5 weeks, we really saw the S&P index. We really saw the NASDAQ pull back. For perspective, the S&P index was 5% higher than where it closed the high of 2020, which was in February. We saw the NASDAQ, which is very tech-laden, and that's a very COVID-positive trade, was in the tech area. We saw that side of the market up about 20%. Now we see the S&P down about 10% and roughly the NASDAQ down about 12% currently. What could be? Well, hopefully we'll have a treatment. Hopefully have a vaccine soon. But I do want to give this information with a point of caution. Just because we have a vaccine doesn't mean everyone's going to be vaccinated all the way. Doesn't mean that the vaccine is going to be effective. I think the effective rate is somewhere around 50, 60% is what they're projecting. And then you want to think about a treatment. I almost feel that a treatment at this particular time, so people don't feel that they're going to be sick or they're going to die. I think it's coming down to a treatment over a vaccine that might have a bigger impact, at least in the shorter run, in terms of the pandemic and the economy coming back online. But we could return to pre-pandemic levels. I do caution again, that is really high levels, and we have real damage in the economy. Whole sectors, whole minorities, whole income brackets that won't come back, or they're going to take a long time to come back in the economy. Now, we could easily stumble and fail to open effectively and stimulate the needed growth that we have to have, which means we could drift into what's called a double dip recession. The last double dip recession we saw was in the 80s, roughly about 1986. Now think about this. It arguably could be said that we are out of a recession and on our way to back to pre-pandemic levels. Arguably, that's probably a little bit ambitious in that statement, but I wouldn't be surprised. Think about it this way. It takes 30, 60, 90 days for our government, the Federal Reserve, to report some of these economic numbers. So really, these are lagging indicators based on what's going on in the economy. If we look at elections, three areas that I probably hear the most concern about is elections, the debt that the government and monetary policy has on the books, and as well as valuations. So let's address all three. Let's talk about elections. What's happened? Put your politics aside and say, what if it's been a Republican or a Democrat? It really hasn't changed what's gone on. If you look over the Obama administration or you've looked over the Trump administration and you've looked at the ebb and flow, the market peaks and troughs and corrections, it's been pretty similar. Stocks have returned roughly 10.2% in 12 months following primaries. And it's 5.8% in similar periods that were non-election years. So the real volatility that I'm expecting, and I've mentioned and we've talked about with many of you on the phone and in our meetings, is probably the volatility that we're going to see and continue to have as we lead into this election. Not that it's going to be over with after the primary and we have a new president or the same president. We're probably just looking at a situation of higher valuations, traditionally a challenging time in the market. Usually it's the fall going into winter, and valuations, not to mention the pandemic that we have. So yeah, I think we're probably set to continue to have some volatility. But at the same time, volatility shouldn't chase you out of the market, because where are you going to go? The interest rates are basically, they're not at zero, but they're pretty darn close. And so let's say that you're blessed to have a 1% return in that money market account. And don't forget about inflation. Inflation is the cost of living, and that generally increases on an ongoing basis. It's been pretty stagnant, around 2%. So if you make 1%, inflation's 2%, what's your real return? It's a negative 1%. So we just want to be cognizant of how long you have your money placed in those low risk, low yielding environment. The fortunate, unfortunate thing that's happened in the economy is they've really pushed us to have to take on more risk, which for stock investors has really paid off. Unfortunately, for bond investors, as inflation increases and the Federal Reserve's mandate is taking the collar off and they want inflation to increase, that means that interest rates will likely start rising over time. Now, keep in mind that the Federal Reserve has already said that their plan is to keep interest rates the same until 2023. But it doesn't mean that the markets couldn't start having interest rates rise on their own. Now, what about staying on the sidelines and trying to time the market? It doesn't really work. Even the best of the best can't get it right. So it's not really time or timing in the market. It's really time that you have in the market. So if we think about 20 election years, we've only had 2 negative years during the last 20 election years, and that was in 2000 and 2008. And the only reason why they were negative is because we had what's called asset bubbles. Tech in 2000, and we had the housing market bubble in 2008. If we look at debt in the economy, now in this chart, we're going to be measuring debt. They're pumping trillions of dollars to prop up and hopefully propel this economy to return to pre-pandemic levels. So they're putting trillions of dollars of monetary stimulus in the policy in the economy. Well, what we want to do is measure that. So we've measured that based on economic policy indicator, and we're looking at times when it's peaked. Think about this. Over the last 50 years, since 1969, this indicator has spiked 7 times. And 6 out of the 7 times, we've entered a bull market that's lasted 4.6 years. In the S&P, the Standard & Poor's Index return was 15.1%. Now, I'm not going to say that's going to happen. There's no crystal ball here. And rarely can you ever expect things to repeat. But the market might have some sort of rhyme or rhythm to it based off the past. So we do want to keep that in mind. Just because we have high debt, there's many times in the past where we started bull markets. Almost every time in the last 50 years, we started a bull market on average of 4.6 years in duration and a 15.1% annualized return for the S&P. Now let's look at valuations. The third concern I always hear. Well, what about valuations? The market's so expensive. And I agree with you. But I agree with the statement is that the market is really expensive in certain areas. Technology, for example. It's really challenging for companies to trade today at valuations that can't be justified for maybe another 5 or 10 years. And that's some of the IPOs that came out. When you start to see splits in stocks, that's another indication. It doesn't mean that the markets have to set themselves up for a big drop. But I think we just saw exactly what happens. The NASDAQ, which is very heavy in technology stocks, pulled back so far already 12%. The S&P is down 10%. So I think the market is telling you exactly valuations in certain areas are too high, and they probably do need to be adjusted. It doesn't mean you need to run for the hills, but it does probably make good sense to evaluate your account and see if you need to pay yourself. Take some profits in some areas that you've done well in. There's nothing wrong with that. That's just a part of good portfolio management. At the end of the day, it's what you make. It's not what's in your portfolio that matters. All right. So let's look at some valuations. The current PE multiple for the S&P index is roughly around 23. If we look over an extended period, let's say we're already going back to 1939, we got an average price to earnings multiple of 15. So if we look at the past and we compare today, it's 15 on average. We're about 23. But let's keep this in mind. Would you be surprised to know that high valuations are pretty much a norm when we start bull markets? If we look over the last 30 years, we've had a trailing PE of 21 times earnings every time we started a bull market. The average is 24. We're only trading at 23. So every time over the last 30 years, when we've at least had a price to earnings multiple well above the average, 21 to 24, we started another bull market. So not necessarily do high valuations mean the end of a bull market. Now keep in mind, bull market runs in the stock market or bond market, they're going to have their fits and starts. You're going to have your ebb and flows. A rule of thumb, and it's just a rule of thumb, is somewhere between a half to a third of a pullback or a correction you could see in the most recent rally. Well, the S&P is roughly up about 40%, just over 40% from the lows during the pandemic. And the NASDAQ is up over 60%. It might be around 50 now, that we pulled back of late. So if we take some of those numbers, that could be anywhere from 12 to 20+% in a pullback that we could still see on top of the 12 and 10% that we already have. Now, again, the statement is not made for you to run for the hills. It's just to be mindful of risk and volatility. And that's just something that we just have to plan for and know is going to be a part of just investing. I do want to, wrap up this call and just really thank everyone for being on it. I wanted it to be short and sweet. I really wanted it to be something that you could just fit into the middle of the day, and I wanted it to be timely topics.